I'm Jennifer Foster, one of the premier investor coaches of South Florida with Smart Plan Investing. We have offices in Jupiter, Florida and Atlanta, Georgia. At Smart Plan Investing, we want to help eliminate confusion around investing, to help you gain critical insights, and to watch your wealth grow over a lifetime. When it comes to investing, I think many investors don't know exactly what they're doing or why they're doing it. At Smart Plan Investing, we provide engineered portfolios, and it is our goal to help investors understand what they're doing and why. Now, one of the things that we utilize in an engineered portfolio is what is called the three-factor model. Eugene Fama is a Nobel Prize winner in the year 2013. He's the professor out of the University of Chicago's Booth School of Business. So he won a Nobel Prize in the area of economic sciences. Now, he did some work with Kenneth French, and it went from a three-factor model to a five-factor model. And so in this video today, I'm going to explain to you what these factors are. The first factor that we're going to talk about today is what is called the market factor. And what Eugene Fama and Kenneth French did was they just researched what has the markets done versus what has the bonds and T-bills done. So if you look historically, it shows that stocks have had a much higher return than that of fixed income. If we could invest in fixed income like bonds and T-bills and get the same rate of return as stocks, we would just invest in the safe money. But unfortunately, there is this correlation between risk and return. So investors are rewarded for taking on, or they expect to be rewarded with higher returns for taking on that additional risk. And historically, we have seen that be the case. Now, there's one caveat here, is it doesn't always show up every single year. So there could be periods of times when fixed income does outperform stocks when stocks are down. So that is one caveat, but it's very rare that that is the case, but it does happen from time to time. So when we're talking about premiums, we're talking about what is the difference that an investor can expect from investing in one thing versus another thing. So just for illustrative purposes, and I'm not saying that these are the numbers, but assume that you could get a 10% return on your stocks investments, and you could get a 2% return on your bond investments. So if you take 10 and you minus 2, that's 8%. So your premium for being invested in stocks versus bonds could possibly be 8%, and that is what we call a premium. The second factor is called the size factor. And what Professor Fama and Ken French did was they looked at the areas of the market, talking about, we're going to look at two different extremes. We're going to look at large companies and small companies. Now, just to be clear, small companies are still, these are companies that are traded on the stock exchanges. These are not your mom-pop, Main Street little, businesses around town. These are huge companies. We're talking, they have a capitalization of 300 million to 2 billion. Now, if you don't know what market cap means, it's just taking, so you can rank companies smallest to largest by their capitalization, which means how many shares do they have outstanding in the market, and multiply that by the price of their stock. That would rank them then smallest to largest based on capitalization. So the small companies would be any company has a market cap between 300 million and 2 billion. So they're really not that small. These are like Papa John's and Skechers, for example. Okay, so that would be like your small companies, and they would be represented by this small egg. Now your large companies, this is the other extreme over here, large companies represented by this egg. And that would be like Apple, Amazon, Facebook, Microsoft, these are your large companies. Now, large companies have a market cap of 10 billion to 300 billion. So I ask investors a lot of times, like, if you were going to invest your money in small companies or large companies, where would you invest your money because you believe you're going to have the highest expected return? Would it be investing in the small companies or the large companies? And most people tell me they would invest in the large companies. So what Professor Fama and Ken French did is they looked at what has the return been of those areas of the market all the way back as far as they can look, like 1926. And surprisingly to most investors is that the small companies actually have had a higher expected return over long periods of time. So it doesn't show up every single year, or maybe not even for a 3 or 5 year period. But investors, when they invest, they're investing for 10, 20, 30 years. And so we want to make sure that we are investing in our engineered portfolios, not only just in large companies like the S&P 500, but also these small companies, because there can be a premium, an additional return that I can capture for being invested in small companies. The third factor is what is called the value factor. So for those of you who didn't know, that there are small companies that you can buy and large companies, and there's also growth companies and value companies. So those are our two extremes. So think of your large and small, and then think of value and growth. If you follow Dave Ramsey, you hear him talk about growth companies a lot. Those are a lot of the S&P 500 companies, although there are some value companies in there as well. So to help you understand what value and growth is, for those of you who are in accounting and understand high book to market and low book to market, so your value companies have a high book to market and your growth companies have a low book to market. For those of you who aren't in accounting, then no problem. I think this illustration will help you understand. So I have two ladies drawn here. I have the bow, and in this example, I have a credit score of 650. Now this is you over here, you have curly hair, and you have a credit score of 800. Now we both go into our local bank and we ask for a $100,000 loan. Now, with a credit score of 650, do you think they're going to give me a loan? Probably. And if you have a credit score of 800, do you think they're going to give you a loan? Probably. Now, who do you think will get a better rate, like interest rate, to pay back your loan? Who would get the better rate? Likely it's going to be the one with the 800 with the higher credit score, right? So we would probably both get the loan, but you're going to pay less interest rate. I'm going to pay higher interest rate. So when we both pay back our loan, who is the bank going to make more money off of? Off of me, because I'm paying more interest. And that's the same thing as a value company. So investors are going to require a larger return on their investment to take on that additional risk, just like the bank would take on the additional risk only if you were paying more in interest. So that's the difference between a value company and a growth company. So what Professor Fama and Ken French did is they looked at all the companies going on as far back as they could look to see, if you were to look at all those companies in value and in growth, which one had the highest expected return historically. And surprisingly, it is those more risky companies, the value companies. And I can tell you from doing tons of investment portfolio analysis is that very few investors are picking up where these additional premiums are in small and in value. So we definitely want to make sure in our engineered portfolio that we're capturing these additional premiums. So a few years back, Professor Fama and Kenneth French, they had some more research that stated that there was two additional factors that they'd want to consider, and that is profitability. So unlike an index fund, if a company isn't profitable, we would be able to filter that company out, not because we're stock picking, but because it wouldn't meet the criteria of what we're building when we're doing an engineered portfolio. So a company that is not profitable is not going to be giving us the expected premium that we would be looking for, as well as a company with low momentum. So momentum is the fifth factor, and so we'll be looking for companies that either have high momentum to put into the portfolio versus those with low momentum. So those two last factors, they only make up a very small portion of the engineering of the portfolio, but I wanted to include those. And you can do your own research if you like, or if you would like more information, you really want to know what actually is the premium of being in the market over fixed income, historically. What is the the premium for being in small companies over large companies and value companies over growth companies. We do host a variety of investor coaching events, so you can reach out to us and we can, get you registered for one of those. We also will help you discover what the common investing pitfalls are, and not just the 3-factor model or 5-factor model that I shared with you today, but other economic investing principles that we follow in constructing an engineered portfolio. So I hope you found that this video was to help you to eliminate confusion around investing, because many people think just buy the big S&P 500 companies. That we have been able to help you gain some critical insights in today's video, and that if you choose to work with us, that we can help you grow your wealth over a lifetime.